My name is Matt Tomko. I'm the Chief Revenue Officer at Happy Money, and I've been in the seat since October of last year. But I've been around the financial services industry for over 28 years now, worked in several asset classes, maybe all of them: personal loan, student loan, credit cards, small business, auto, mortgage, sort of you name it. A lot of my career, early part of my career, was spent in risk. So mostly credit and collections, which is a little bit by design why I was asked to take the revenue role here at Happy Money. Quick background on Happy Money. We're a consumer finance company. We empower people to achieve their goals through a responsible approach to lending. We partner with credit unions, banks, and asset managers to create high quality loans and diversify their balance sheets and ultimately help them to grow. And it's a great marriage for our funding partners and our customers, because our customers benefit from lower rates, transparent products, and obviously our funding partners are getting great assets. So currently at Happy Money, we are in a place where we're very, very focused on producing those high quality, high performing assets. So that's why the risk approach, I think, is important, even when we're talking about something like the revenue and the growth side of the equation. I'll talk a little bit about Concerto first. That was a startup card business. And card, as I think everybody understands, is a very, very competitive space dominated by the big banks. So we were starting from zero, and we had to develop a platform, a product, our capabilities, our distribution model. And again, in a crowded space where we didn't have millions, if not billions of dollars to build out a brand to compete with the likes of the big guys. And the hardest thing about card is inevitably you create a really deep J curve. So the cost of acquisition takes, on average, probably about 3 years to recover that acquisition cost by the time balances build up and revenue starts to be generated off a card portfolio. And so we looked at that and said, what's a way that we can get through that quicker? It really leaned into partnership. So partnering with established brands that have recognition and a loyal customer base. And by marketing to that captive base in a really unique sort of way, we were able to acquire customers less expensively and resulted in assets that performed better, higher loyalty, better performance overall. So that was our early stage hack in terms of figuring out how to go to market and really make a little bit of a dent and carve out a niche, again, in a segment that's really, really competitive and difficult to compete in. So Happy Money, look, much different story. When I showed up, there was a product in market, a great platform, a great team, a little bit of history to lean on. So that was a relief, honestly, and it put us in a very good position. We were just in a very different place in our evolution. I think we were coming out of, the industry-wide kind of, tightening that happened middle of 2022, really into 2024 when the interest rates went up. Capital was a little bit more constrained. So Happy Money was very focused on very efficient acquisition and only operating in a couple of channels, namely kind of the digital affiliates. Now we've gotten to a place that we've diversified our funding, just announced a pretty big deal with Fortress and Edge. That's a $500 million forward flow purchase agreement for our loans that we're originating, and then marry that with the credit unions that have been longtime partners of ours through thick and thin, and they're still looking for our assets as well. So we're tasked with meeting that growth or that demand for growth that those partners are looking for. So we're going back into a lot of channels that we haven't been into in a long time. So some of the digital channels, definitely the direct marketing channels, things like mail and email, and really trying to drive that growth. So I think a lot of the analytics and the work that we're doing is really trying to understand the individual cost of acquisition in those channels. How do they interplay off of each other? And as we're rebuilding that omni-channel marketing, are we measuring the incrementality of each channel against each other? So that's kind of the most important thing. And again, I'd call that a little bit of blocking and tackling. The other place that I think we're focused in on is lifetime value modeling. I think historically, Happy Money had a very utopian view toward, if you get our product once, you're going to be out of debt and you're in a better place. I think the reality is, if you look at customer behavior and the cycle of credit, sometimes customers need to consolidate multiple times to maintain their personal balance sheets and to be in a good spot. So looking at the lifetime value, how can we do second loans and things like that, I think is going to be important as we grow, along with doing that omni-channel analysis to understand the efficiency of our marketing channels. Yeah, I mean, what I've learned working at big companies, small companies, at various stages of development, regardless of your lending organization, everyone's got to be accountable for compliance on some level. It's a highly regulated industry that we work in, which is a good thing. Larger organizations, I think, have the luxury of probably multiple lines of defense, like a third line audit, second line compliance, first line of defense, being the line of business. Small organizations, you don't have all of that. So I think you need to really have the right people, have experienced people in the roles, whether they're in servicing or credit or fraud or marketing, but really asking the right questions and being very in tune with compliance themselves, right? I think otherwise you're going to have blind spots that create risk that really isn't solved for by other tools or other lines of defense. I just think you need to have the right people with compliance in mind from the jump, and that's something I've learned over the course of my career. But look, where we are today, with AI and machine learning, innovation's moving at a pace that I think is quicker than I've seen in several decades. So, and that type of innovation right now is different in that it's a little bit more black box based. It's not as easy as, parsing out the code or looking at some model attributes and being able to describe to a regulator exactly what's happening. I think there's a lot more monitoring tools that are required to measure things like disparate impact and really having a good feel for the output of what these tools are doing. So, I mean, look, it really takes the right people with a lot of experience, asking the right questions, having that background of, where are the pitfalls that I need to be aware of. I mean, it's interesting. I mentioned AI and those sorts of tools. I really do think, going forward, it can be extremely helpful as sort of building your own internal regulatory watchdog. I think that's probably one of the more interesting places where AI can do a good job taking a ton of data, look at a lot of different signals, and really understand, are you outputting something that you didn't intend to do? And that's honestly the hardest thing to recognize or to find when you talk about your regulatory framework. So yeah, compliance regulation is really everyone's job in the organization when you're talking about a lending company. Moving really quick, but some of those tools might actually be able to help a great deal by picking up things that maybe your eyeball wouldn't. Yeah, look, I think, we're still, again, in a little bit of a building phase. So I would say that at an enterprise level kind of tools, a lot of what we're doing is very traditional in terms of looking at the business as a whole. If I drill into each sort of channel that we're trying to generate growth or revenue out of, because the two sort of run hand in hand with us, we're trying to maximize our margins, but ultimately we need to put on loans, and that's marketing at the end of the day. So if I break that down by acquisition channel, digital, we've actually partnered with some really great agencies on digital, and we've upped our game with things around our Google G4 analytics platform, right? So we're pulling that data into our business intelligence tools like Looker and Tableau, and really have a lot of that data to manipulate at our fingertips to really try to drill into areas where we think that we're accretive and dial back on the areas where we know that things may be more expensive than ultimately what the result of the channel would be. We're also diving into HubSpot quite a bit. We really want to use it not only to manage some of our sales tools and things like that with our credit union partnerships, but we're also using it on a B2C basis, trying to use it as a lead gen engine so that we can generate more of a population that we can plug into that CRM and be able to constantly have a communication with about our product and be there when the customer may need it. Direct mail is an interesting one. That's, we're a fintech. We work in a very digital age. Direct mail still works. It's the old dinosaur that continues to produce. And there's a lot of data that comes out and a lot of learnings that come out of direct mail campaigns. So we partner with our mail shops, obviously, but a tool that I love is Mintel Compromedia, not only for seeing creatives and how you stack up in the marketplace, but there's a lot of analytic tools in there that help you to be efficient and understand how you compete, how you stack up, and what your addressable market is seeing in their mailboxes. And then lastly, affiliates is probably our other big channel. So it's the Credit Karmas of the world, NerdWallet, LendingTree. We rely on them heavily for the data that they're able to provide. So they don't give us everything within their black box, but there's a lot of good insight and signals there that really need to be mined to understand sort of where you sit competitively in those really, really critical, important channels that really drive a lot of our volume. Yeah, look, what I learned working at big companies is it's really hard for traditional, highly regulated financial institutions to keep pace with the innovation that we're seeing on the fintech side. By design, they're built to be stable, right? And change by its nature creates some level of instability. So innovation is approached really cautiously at big financial institutions. And for all of us that are consumers of those organizations and probably have deposit accounts and everything else, that's probably a good thing, right? You need the safety and soundness of those big organizations. Tech-enabled startups like, Happy Money, we can accelerate that pace of innovation, and create some solutions that create really positive customer experiences and leverage our technology, and marrying that with, some of the credit risk and forward-thinking kind of modeling that we can do that maybe a bank couldn't. So at the end of the day, I think large companies, large banks, credit unions should probably look to partner with fintechs, whether that be in a traditional sort of just partnership approach or acquisition. I think they should look to what's being developed on the fintech side, not necessarily try to build it themselves, and ultimately understand ways that they can leverage tools that have been developed in the smaller companies and the more nimble sort of organizations to enhance their customer experience. So look, I think we are more than willing to partner. I think I already talked a little bit about, we've partnered with banks and credit unions and willing to give them access to our platform, obviously access to our assets. And I think there's some really good partnerships and opportunities that will evolve as we move forward when, again, the pace of innovation is faster than it's ever been. Banks are still highly, highly regulated. They need to be a little bit cautious in their approach to innovation. So I think what we're going to see is a lot more partnership across traditional financial institutions and fintechs like Happy Money and others. Yeah, look, again, 28 years, I've been around long enough to see a couple volatile periods. So I don't know if there's a great playbook for any of them, but there's sort of three core tenets that I think of that are good in any business environment, but are all that much more important when things get a little bit tough. And, the first one is transparency. From a leadership team down, making sure the organization knows exactly what the goals are, where we stand against those goals, and the things that we're doing to try to achieve them. And it's not always good news. So I think you need to encourage the information, both up and down. I've known our CEO, Matt Pateri, for a long time. He and I both date back to MBA in the late 90s, if I really want to age myself a little bit. But it's the first opportunity that he and I have had the chance to work together. And he's got a mantra that is bad news fast, good news slow. The theory being that, when something good happens, everyone can't wait to tell their boss about it, right? You achieve a goal, you get a new client, whatever, you're going to go running to your boss and talk about it. And that's great. Those are the things that you want to hear. But the news that you need to hear is when you identify something that's wrong, whether it's your fault or not, because at least when you know about it, you can take action. You can quickly learn, you can correct, you can move forward. So here at Happy Money, we try to celebrate a little bit when someone identifies something that's not working the way that it should, right? Because we're trying to encourage people to identify those things, because that's the only way that we're going to get better. So on the other side, when the indicators flip positive, that's when you really need to celebrate those moments and recognize people for doing the good things. But again, you need to have transparency throughout the organization, both flowing up and flowing down, and that's both on good news and bad news. So that's critical so we can all stay aligned in our mission. Number two is celebrating the small wins. When the numbers aren't going in your favor, you got to identify the things that are moving your organization forward, make a big deal about those. So it could be enhancements in marketing or credit or servicing, technology, not necessarily producing the numbers today, but when the cycle changes, and inevitably it always does. Things can seem rough, but stay around long enough, it will turn in your favor if you can survive it. And when that does happen, those little wins, those victories, those enhancements have put you in a much better position to go out and obtain market share that you otherwise wouldn't have been able to get had you not done those things in that time of a downturn. So celebrate those things, even though they're not necessarily the bottom line numbers. And then the last one, look, focus on the consumer. It's good in every time, but really when times get tough, listen to the consumer, respond to their needs, make sure that your product is geared toward the current market that they're facing and what they need as a customer. Make sure you're listening to the feedback. Make sure you're adjusting as needed to make sure that you're doing everything you can for your customer. Because if you're there for them when times are tough, inevitably they're going to recognize that. They're going to remember that. They'll be there when the times get better. And again, when you're trying to grow and gain market share. So again, a focus on the customer, commitment to the customer is always good business. And it's never more critical than when things are tough in a cycle. Yeah, look, financial education of personal financial management always sort of remains a tough one. A lot of organizations have tried to solve it. It's a big component of what we try to do, right? We're trying to empower people to achieve their goals through lending, but with that, we're trying to always enhance our suite of tools around financial education, financial monitoring, helping customers to make better decisions around their finances. But, I think it's a tough one on a couple fronts. Like, one, we only have a limited picture of the customer's financial picture. We're focused on their debt. We see a little bit in terms of when they apply of income and things like that, but we don't get a full picture of that customer. The other piece is it's really hard to monetize as a standalone product without, really just using it as a lead engine and then marketing like crazy. Customers don't like that. Like, they want to go to someone trusted. They don't want to go and just assume that you're going to go sell their information. They really want someone who cares about their financial well-being, giving them good information, good advice. So it's a hard one. And I think a lot of companies have attempted it in a lot of different ways, and I think a lot of companies kind of lose their way in that mission. You asked who might be able to solve that problem. Look, I really like Intuit Credit Karma and the things that they're doing right now. I mean, look, they're a partner of ours in terms of generating leads and things like that, but I think of it on a grander scale. Like, they've got a full picture of a customer in terms of, on the Intuit side, they've got a lot of the tax information, and they can see the levels of income and expense and a lot of information out of the taxes. They're looking at the credit bureau information. They're seeing what the customer is lending. They're looking at homes. They're getting into deposits. So I think they've got some really amazing data, and they've got trust of hundreds of millions of consumers right now. So I think they've got the scale to potentially do even more than they already do. I mean, look, it's already a great product and a great platform that they've got out there, but I think they could do even further and unlock a lot of personalization and a lot of things that their platform could do that they haven't yet monetized or developed today. So yeah, I think that's really the place where that personalization, the use of all the data, and companies like Credit Karma that have a lot of the different, views into a customer's financial picture will be best suited to make those moves. Yeah, I mean, look, I'll start on the macro side, I guess. Consumer debts are at relatively high levels. Inflation and everything else that's happening in the economy and policy have driven consumer debts relatively high. And if you look at interest rates on credit cards, they're reaching historical highs as well. Products like ours, honestly, are going to be important to put customers' personal balance sheets in better places. That's going to be sort of a kind of a midterm approach. I think, customers are going to be looking for ways to make sure they're meeting their obligations and have the liquidity they need to live their lives. And I think consolidation products are one of the things that will continue to grow. I mean, they have the last few years, but I think you'll see even more of that, just again, based on the amount of credit card debt that's out there and the rates that credit cards charge, and then the rates that you can achieve on a personal loan to really put yourself in a better financial position. But in terms of the technology that's going to assist that sort of product dynamic is, AI. Again, I keep coming back to that, but just the amount of data that's being created at the speed of light at this point, or even, potentially faster. Like, the amount of data that we have can be used to personalize and reduce friction for customers who are looking for any financial service product. But, our entire lives are being lived digitally. All that information can be used, tailor a credit product, present it to you at the right time, and then make sure that you're uniquely qualified to be able to obtain that product, pay it back responsibly, and put you into a better position. So again, I think the machine learning tools, the AI models will help to drive that personalization and the convenience to get into products that will help right-size a customer's balance sheet. I really appreciate the opportunity to sit down and talk about the growth side of our business and some of the things that are top of mind at Happy Money. We are elevating the Happy Money brand and looking to get out there in a meaningful way. So both, if you're looking to acquire assets as a bank, a credit union, or an asset manager, happy to partner to create that opportunity. And look, if you're a customer that's listening and you're looking for a great personal loan and looking to put your own personal balance sheet into a better spot, we'd love to help.